Broadcast is now starting. All attendees are in listen-only mode.
Hello, and thank you all for joining us this morning. My name is Katrina Johansson, and I am the Executive Director of the California School Finance Authority, or CSFA. As the Chair of CSFA, State Treasurer Fiona Ma recently called on the authority to assist California's education sector weather the COVID-induced recession and the effects of state deferrals. The webinar is part of this assistance process. We hope you find the webinar informative and that it provides you with the tools you will need to withstand the state deferrals and these unprecedented times. We have convened an esteemed panel of experts to address these matters, and at this time it is my honor and privilege to welcome State Treasurer Fiona Ma and former Superintendent of Public Instruction, Jack O'Connell. Welcome.
Good morning, everyone, and thank you to the California School Financing Authority for hosting this educational seminar. The California Debt and Investment Advisory Committee for the support and assistance in ensuring the success of this webinar. This is a first in a series of educational webinars sponsored by CSFA. And welcome to the 1,000 participants that registered for this important event to learn more about the state's 2021 budget and plan deferrals and the significant impact the deferrals will have on districts' cash management. Participants will also learn more about tax and revenue anticipation notes that will help districts weather the deferrals. As the chair of the California School Financing Authority, we are working to help schools throughout the state facing economic repercussions resulting from the global response to the coronavirus pandemic. As the chair of the CSFA, we work closely with the authority's other two members, Superintendent of Public Instruction Tony Thurman and the Director of Finance Keely Martin Bosler, to ensure that California's public schools have the educational facilities and working capital they need. We also work to ensure that the programs the authority administers are done so responsibly, with an emphasis on developing best practices that ensure that coveted state and federal dollars are deployed and used in the manner they were intended. Today, we are joined by former Superintendent of Public Instruction and CSFA board member Jack O'Connell. Jack has been a distinguished public servant and public policy advocate in California for over 40 years, all 4 of those decades spent in public education. In his 28-year career as a public servant, Jack served in all major areas of elected leadership in the state. He began his public service career as a teacher at his alma mater, Oxnard High School, where my husband was born and raised and still lives. He subsequently successfully ran to serve California's 35th district in the state assembly, where he served from 1982 to 1994. This was followed by his term on the Santa Barbara County School Board, where he served from 1994 to 1996, during which time he was elected as state senator for California's 18th district. During his time in the legislature, Jack was integral in the authorship and passage of Prop 39 in 2000, which reduced the threshold to pass local school district bonds from 2/3 to 55%. Since Proposition 39's passage and through January 2011, voters have approved $23 billion in school bonds that would have failed under the 2/3 requirement. In 2002, Jack successfully ran to be the superintendent of public instruction. In his time as superintendent, Jack helped shrink class sizes, cement higher academic standards, and close the racial achievement gap. Jack also steadfastly guided the Department of Education during California's last major fiscal crisis, namely the Great Recession. When California's shriveling state budget squeezed schools, Jack zoomed around the state to call for more funding while urging schools to stay on target and continue to do more with less. Thanks to his leadership, California schools and students came out of that recession stronger, smarter, and more nimble. Jack has also served as a member and chair on a number of boards, commissions, and authorities, including CalSTRS. His experience with and understanding of California education policy is unrivaled, and he has been one of California's true education leaders. So my first question to you, Jack, is when you were superintendent during the last major fiscal crisis that affected our state and our schools, can you tell us something about that experience for you, life in the trenches, lessons learned, etc.?
Yes, and Treasurer Ma, thank you very much for doing this and that generous introduction. I couldn't have written that any better myself, and for stating that I zoomed around the state during that Great Recession. Now I'm doing a different type of zooming here with you today. But I can tell you during that Great Recession, and I said it then and I'm going to say it again now with this pandemic and the many challenges that we face, our students aren't going to wait. We cannot make excuses. We have to prepare our students for the future, whether it's going to college, career, to become better citizens in this democracy. Our students aren't going to check the general fund of the state of California, but our students are counting on us. So what I said then to the education community, and I would say the same thing today, we have to be creative. We have to be innovative. We have to go out and form and try new things, form new partnerships with folks. We have to be more creative than ever before. Get our state treasurer actively involved in helping us, just exactly like you're doing. We're facing, as you referenced, the largest deferrals in terms of dollars that we've ever had. I think you're going to hear from two good friends of mine and two great guys, John Gray and Mike Fine. These are the largest amounts of deferrals we've ever had. Maybe not in terms of percentage of the state general fund, but just in terms of real dollars. And you're going to hear that from two eloquent spokespeople. But while we don't know how much money might be coming to help us from the federal government, one thing that we do know with certainty is we have a state treasurer who's a strong supporter of public education. And so this whole idea of putting this together and seeking your help and that of the School Finance Authority was really Kevin Gordon, who's a friend of yours, the president of Capital Advisors. And Kevin said, given the magnitude of this problem for so many of our school districts, for so many of our county offices of education, and yes, for so many of our charter schools, part of our public school family, how can we bring down the cost of borrowing? And so Kevin wanted to try to create more competition within this realm. So how can we get you to help us get additional, our 58 county treasurers involved? How can we have more options? How can we get more competition to drive the costs down on the schools with their already stretched budget? And so this is the type of innovation, creativity, assistance that we so desperately need.
So yeah, thank you, Jack. So besides managing the state's money, all the revenues, about $2.6 trillion every year, about $100 billion in short-term investments, and also selling bonds, I chair 16 different boards and commissions, and one is CSFA. And one of the mandates that I've, really asked my executive directors is, what can we do to assist more? I am a product of the public schools. My mother was a public school art teacher for 19 years. And so my heart and passion is with making sure that every student has the best opportunity, quality education to learn, regardless of whether they can afford to go to school or not. It should be free. And so I thank you, Jack, for all that you're doing. I know Kevin has been a great mentor to me when it comes to education, what is happening. And I thank him for sparking this idea of having this webinar and also pushing our organization to do more, even in this time when so many people are seeking our guidance, our assistance, and financial and fiscal assistance. So again, I want to thank Jack for your long-term service and leadership, and for being just a good friend and mentor to me over these years. And I'm going to turn it over to Katrina Johansson, Executive Director of CSFA, to provide remarks, introduce the panelists, and provide an overview of CSFA. So thank you again, Jack.
Thank you. Thank you.
Thank you so much. And now it is time for the obligatory housekeeping slide. If at any time you're experiencing any technical problems, please contact GoToMeeting at 877-582-7011, or you can try the website at the address on the screen to troubleshoot your problems. The slides for today's presentation are available in PDF form in the handout section of this webinar control panel. And again, it will be posted to the CSFA website shortly. We also encourage you to submit questions during the broadcast using the box marked questions near the bottom of your control panel. You may submit questions at any time as they come to mind. Time permitting, we will be taking as many questions as we can at the end of our session during the Q&A period. Additionally, if you would like access to live captioning during this program, click on the link in the chat section at the bottom of your control panel or copy and paste the address on the screen into a second web browser. And lastly, CSFA, again, will make this recording available on our website for replay as soon as possible. The California School Finance Authority was created in 1985 when then State Treasurer Jess Unruh had a vision to expand the powers of the Treasurer's Office. He created boards, commissions, and authorities to meet various infrastructure needs throughout the state, including educational and health facilities, pollution control, and advanced transportation and alternative energy. CSFA was created to finance educational facilities and working capital on behalf of school districts, county offices of education, community college districts, and most recently, nonprofit charter school borrowers. As a governmental entity, CSFA is governed by a 3-member board, with 2 of those members being statewide elected officials. As mentioned earlier, the authority is chaired by State Treasurers Fiona Ma, with Superintendent of Public Instruction Tony Thurman and Director of Finance Keely Martin Bosler serving as members. CSFA currently administers 10 active state and federal debt and grant programs, and since 2002, the authority has disbursed over $4 billion to K-12 schools. As drafted, the CSFA Act provides broad statutory authority to issue short and long-term debt on a standalone or pooled basis. CSFA is set apart from other conduit issuers due to its state-level intercept mechanism, which can be found in Section 171994 of the Education Code. The intercept mechanism allows borrowers to make debt service payments at the state level. Through an intercept schedule, borrowers notify the state controller to make payments on behalf of investors to bond trustees. This mechanism ensures timely payments and improves investor security and credit quality. Additionally, CSFA is supported by the State Treasurer's Office Public Finance Division. As agent for sale, the Public Finance Division oversees all bond and note pricing activity and other tasks to ensure public borrowers are properly protected throughout the sometimes confusing issuance process, as well as ensuring quality pricing and cost containment. The State Attorney General's Office serves as issuer's counsel on all financing issued through CSFA. Notably, CSFA holds monthly board meetings and has the flexibility to hold special meetings if financings are time sensitive. And for nonprofit borrowers, CSFA conducts state-level no-cost TEFRA hearings. And lastly, as a governmental entity, CSFA is mission-driven, not transaction-driven. All debt issued through CSFA is placed with investors commensurate with the credit quality set forth in our bond issuance guidelines. CSFA is competitive, low interest, and administrative fees for both nonprofit borrowers and public agencies. The full fee schedule is available on our website. And lastly, CSFA's consistent leadership, top financial advisor support, and Treasurer's Office backing provides institutional knowledge and area expertise unique to the authority over other conduit issuers. Since 1999, CSFA has issued over $1.7 billion in short and long-term debt on behalf of school districts and nonprofit borrowers. Of the 93 transactions closed, 18 were working capital note financings totaling almost $200 million, while 75 financings were issued on a long-term basis. CSFA has been awarded 3 federal grants totaling $37 million to enhance debt issued through the authority. One of these grant programs has leveraged an $8 million grant 18 times, resulting in almost $150 million in issuance. And more recently, CSFA was issuer for school district financing utilizing successor redevelopment agency revenue to construct a new district transportation facility. And CSFA was currently named issuer for community college student housing financing, that will come to the board this fall. And just a quick fun fact, in 2010, CSFA received the Bond Buyers Deal of the West Award for an innovative qualified school construction bond financing. At this time, we are thrilled to introduce our panel of experts. John Gray is President and CEO of School Services of California. Mike Fine is CEO of the Fiscal Crisis and Management Assistance Team, or FCMAT. And rounding out our panel are Annette Yee and Mike Kramer, both managing directors for Montague DeRose and Associates. At this time, I will turn it over to John Gray. John?
Thank you, Katrina. Mike Fine is going to assist me with advancing these slides. So Mike, if you could give us the first slide. And so why are we talking about cash deferrals? We haven't had to deal with these since the last recession. You remember when Governor Brown got into office, one of his commitments was to buy down that wall of debt. Well, a significant portion of that were the deferrals that we suffered during the last recession. So why are we talking about them now? I think the treasurer and Jack O'Connell did a good job setting it up. Yes, we have that global pandemic. It's impacting our national economy, the world economy, and more importantly for us, our state economy. And as a result, Proposition 98, which funds K-14 education, is also taking its hit. So our governor, just a few months ago in May, faced with this budget hole, proposed a budget that would balance the budget and stay within the Proposition 98 guarantee. And just a few months ago, we were looking at some pretty significant cuts to funding for school districts and community colleges. You might remember we were talking about a 10% cut in unrestricted general fund revenues. We were talking about categorical programs being cut in half. And yes, a component of it with the May revision was some deferrals. Well, through the negotiations to the final budget, we got a compromise, and that's what this chart right here represents. And so instead of a giant cut to some of our categorical programs and a giant cut to the local control funding formula, it was a different solution. And so part of it was a withdrawal from the public school system stabilization account. There was some reductions in funding. Remember, you're not getting a cost of living adjustment. But the primary source to bridge the gap were deferrals, increasing deferrals significantly from the May revise. So what we'll be focusing on today is those cash deferrals. So if you're in a school district or a community colleges, a lot of your stakeholders are saying, you know, we dodged a bullet, right? We're not going to have that dramatic cut in revenues. But instead, they've handed you another issue you need to deal with, and it's just as important, but it's solvable. But you got to pay attention, know how it impacts you, and be proactive. So you're going to hear terms each year as the budget comes out. Is it a budget deferral or is it a cash deferral? For your purposes, you need to think of just the cash deferrals, meaning what is the cash that I'm going to be shorted during a period of time. So simply stated, a cash deferral is when you're owed an apportionment from the state of California, your state aid, and the state says, you know what, I'm not going to give that to you right now, but you can go ahead and book an accounts receivable so you can recognize the revenue, but I'm not going to give you the cash until later. And so most of your stakeholders are looking at cash deferrals as well. I didn't get a hit in revenue, but if you're the CBO, the superintendent, the chancellor, governing board members, you need to pay attention to that, and that is cash. The way businesses go out of business in private industry is they run out of cash. Same thing for school districts and community colleges. There's basically three ways you can increase cash. One is you can increase revenues, and think of a private company. You can increase sales, raise prices. But as a school district and a community college, you don't have a lot of flexibility in that area. The rates are determined by the state, and the number of students you serve is the other factor in there. So that's not going to be your solution just deciding to raise revenues. The other way you preserve cash is to cut expenses. Well, the amount of these deferrals are so significant, it's hard for me to imagine any district or community college having enough expenditure cuts to mitigate the cost of this deferral. So those are the first two options. And then the third is, can I borrow money? And that's what the focus is going to be on today. What are those options and how do you manage them? So the difference between a budget deferral and a cash deferral, the cash deferral is what directly impacts you. The budget deferral, think of that as the state and how they're looking at the problem. The best example was the deferral we just had recently when we deferred cash from June to July. They counted the budget deferral as $1.85 billion, but you had the full cash deferral. So the whole $4.38 billion was the cash deferral. So as you think about this and terminology going forward, it's the cash deferrals that impact you. The budget deferrals is how it impacts the state of California. So this next slide that I'm going to show you rather quickly, this came right out of a school district SACS report during the middle of the Great Recession, right? And common wisdom in a school district, and by the way, most of your stakeholders are thinking, you know, as long as we have an ending fund balance, we're good. And I would agree in most times. So during normal times when cash isn't being deferred and you have an ending fund balance, your cash isn't exactly that balance, but it can be pretty close. So this example right here that I'm showing you, I have two numbers circled. So this was a district with about $100 million budget. They ended the year with about $17 million in fund balance. You can see that bottom number circled at the bottom. But look at their cash balance at the top. They actually had negative cash. That was the result of the cash deferrals that occurred during that time period. So now for this example, they probably had money in other funds, but it shows you the impact to your budget. So fund balance is good. You need to maintain that fund balance. But when we're talking about deferrals, it isn't cash. And most of your stakeholders don't spend any time on the balance sheet. And if you think about it, during normal times, if you have good systems, good controls, you're reconciling accounts, you have checks and balances, you have to maintain and watch those accounts on the balance sheet, but it isn't as critical as it is going to be now. You don't want to run out of cash. So the next slide. So this was the first deferral, and by the way, it's in the rearview mirror for almost all of you, And so we had a $4.23 billion deferral. So in June of 2020, you booked an accounts receivable for your state aid in 1920, but you didn't actually receive the cash in July. And so this is the example where I'll highlight the difference between a budget deferral and a cash deferral. So the state talked about it as a budget deferral of $1.85 billion, but they deferred all of the cash, $4.23 billion. And so they didn't take part of your apportionment, they took all of your apportionment. So the next slide. So what did they take? Well, if you're familiar with how you receive your funding from various sources. You get state aid, meaning money from the state of California. You likely get property taxes. You might have the education protection account. So the deferrals specifically focus on that state aid, meaning the state aid that you receive for things like the local control funding formula, special education, and so on. What is not impacted are your local property tax collections. You will continue to receive cash based on your local property tax collections. And although the EPA account dollars are jumping all around, that is not part of the deferral. So it's that state aid portion that gets deferred. So knowing your balance between how much state aid I get and how much property taxes and other funds I get will determine the amount of your cash shortage. So if you're heavily reliant on your state, you're going to have bigger deferrals. So here's a depiction of the deferrals that were in the adopted budget. Couple of things, they're ongoing and they are significant. So if you look at that first deferral, so February of next year gets deferred all the way to November of the following year, the following fiscal year. So February all the way to November. And then you can see March is deferred all the way to October, April to September, and so on. So the deferrals are significant, and it's going to require most districts to borrow one way or another, whether it's internally or from another state agency, or if they have to actually go out and possibly issue tax revenue anticipation notes. Now, by the way, there's a provision that if federal dollars come in, a huge portion of these deferrals would be bought out, about half of it. But again, we're relying on the federal government for that. For your purposes, I don't believe you can count on that right now. So the next slide. The next slide should be community college deferrals. Now, community colleges also are going to have their apportionments deferred, their state aid portion. And Mike, tell us what's a little bit different about community college deferrals.
Well, thank you, John. Community college deferrals for our community college audience, or members of our audience from community colleges, you know this very well. Title V provides apportionment schedules that are weighted a little heavily towards the first part of the fiscal year, as opposed to the K-12 schedules that are a little bit more even across the year. And so the deferrals that begin in February to achieve that full $1.45 billion may require the Chancellor's Office to defer not only your principal apportionment, but a portion of your categorical funds as well to achieve the total. And so it's just the anomaly of the monthly apportionment schedule as compared to the total dollar value that is slated in the budget. So just a little bit different scenario for community colleges.
Thanks, Mike. And so the next slide that we're showing you, these are our, back one, Mike. These are our calculations that we did independently at School Services. Yeah, this slide right here. We've checked with the state. These are not official numbers. These are our numbers, but we think they're really close. And so we're trying to show you what the impact would be on your state aid portion of cash during the months of the deferrals as presented on that prior chart. So I'll just go with February 21st. Remember, that's being deferred all the way to November of the following year. Now, about 90% of K-12 districts have what's called a 559 schedule on how they receive their apportionments. And so this would be applicable for about 90% of the districts in the state. The other 10% have a different schedule, and we've done an estimate on that schedule, but I'm going to only show you one for this webinar. And so you can see that so in February, you should get about 9% of your annual apportionment. We believe about 45% of that will be deferred. And as a result, you're going to receive about 5% of your apportionment. And you can see as it goes all the way down to the bottom in June when the entire apportionment is deferred. So to the next slide. So that creates some issues out there that during the last recession, we talked about these same issues, but at the end of the day, we just march forward. The deferrals are going to impact districts differently. As I mentioned earlier, low property wealth districts are going to get hit hardest. You are going to have to borrow more because a bigger portion of your apportionments are from state aid and not property taxes. And also recognize that when things get better, and they will, and Prop 98 recovers, oftentimes the first call on those dollars are to restore these deferrals before we start seeing new money in public education. So next slide.
John, I would offer one thing, and that is this is exactly the same case for community college districts, except that as a component of LCFF, it's a component of the student-centered funding formula, but the low wealth, high wealth issues are exactly the same.
Yeah, thank you. So, so what's available to you out there? And I'll just do a quick update here, and Mike and Annette are going to go through more detail on this. And just think about it as your family budget. Think about your employer coming to you and telling you, hey, the good news is the company's having some issues, but we're going to hold your salary harmless. We're not going to reduce your salary. However, we're not going to give you your next 3 paychecks because we need to get through a rough period. And on that 4th month, we're going to give you all 3 of those paychecks plus the paycheck you earn in that month. And so at first you're saying, oh, what a relief. I'm not being cut. Then you start thinking, wait a minute, each month I've got a mortgage payment or a rent payment. So think of your payroll in a community college or a K-12 district, maybe a car payment, that sort of thing. And you've balanced your budget knowing what your monthly paycheck is and what the expenses are, and you have the cash. And now you figure out, I'm going to go for 3 months without any cash. I'm going to get it that 4th month, but how do I get through these 3 months when I'm not receiving a paycheck? So the first option, think of your home budget. Maybe you have a savings account. Think of that as internal borrowing. Maybe you have money or cash in another fund that you can borrow. If you don't have that option, maybe you ask your mom, dad, your mother-in-law, father-in-law, cousin, whatever. Think of the county office of ed and the county treasurer. You can borrow money from them, right? But remember, they only have so much cash themselves, and you're not the only district or community college in that area. So that might not be a way to solve your cash problem. And that leaves you with your final option is you go out and borrow. You go to the bank and say, here's a letter from the district. I'm going to get 4 payments in 4 months, so I'm good for the money. I just need cash to help me through this tough time. And so Mike and Annette are going to talk a little bit more specifically on the mechanics on how that works. So next slide, there is a deferral exemption. My recommendation is don't count on it. You would still have to go through all the same machinations that you would have to do to look at your internal borrowings, your external borrowings. Yes, there is a deferral exemption. It's capped at a total dollar amount. You must demonstrate that you have no other option. And if we're not able to borrow cash, you would have to show that you need a state emergency loan. I'm sure Mike has comments on that, but I would say to you, I would not rely on this as your ticket through this. I think you're going to have to use the same due diligence as if you're going to have to borrow yourself. Do you want to add anything to that, Mike?
Yeah, I would agree. The threshold here is pretty significant. You have to exhaust your borrowing opportunities that you just laid out, John, and you have to basically almost qualify for an emergency appropriation, which most of the audience understands is another term for a state takeover of your LEA or of your community college. I do want to point out that the applicable numbers for community colleges is there's a $30 million maximum per month for all community college districts. There are limited circumstances that can be raised to 60 million. You do have to give the chancellor's office 2-month prior notice that you would have a hardship. For K-12, you have to determine that hardship for all months in January. So your application, if you will, to your county superintendent and the Department of Ed has to be in January. And then for the community colleges, your application in the chancellor's office has to be 2 months prior to the deferral date.
Thanks, Mike. So what should you be doing now? You should be reconciling cash. You should be doing your cash flows. You should update your cash flows each month. If the projections aren't coming in as projected, you need to find out why and readjust those cash flows and balance those balance sheet accounts on a monthly basis. So that leads us to this final slide of mine. It's a cartoon that we actually pulled from the last recession. And we've always talked about cash is king, or cash shows no mercy. But during the last recession, school districts and community colleges weren't going to be able to get through their operations each year without ultimately going out and borrowing money. So the king is handing his crown, cash is handing his crown to credit. So Mike, these next slides are yours.
Well, thank you, John, and thank you to the treasurer and to Jack O'Connell for participating as well, and for the treasurers stepping up here and helping each of you meet your cash flow needs. So I want to take just a slightly deeper dive into John's last slide before his cartoon about the key steps in both preparing on the left side and monitoring cash. The monitoring cash, which we do somewhat well, is completely dependent upon how good our cash forecast is. And so on the preparation side, remind all of the K-12 districts and charter schools out there that cash flow is one of the 3 critical reports that you prepare and file with your county superintendent, and county superintendents file with the state. In addition to the budget, which is critically important, the multi-year financial projection, cash flow is equally important. And most of you know that FCMAP provides free to you some sophisticated software called Projection Pro and other tools to you to help you do your MYPs and do your multi-year cash flows as well. John's alluded to this. You must balance your cash flow to the budget. And you do that ultimately through the accrual process, and we'll talk more about that in a second. Your cash flow forecast is going to be based on historical information. Apply current budget details to that. You're going to update it for any new appropriation schedules and apportionment schedules. And then on the expenditure side, with respect to any new or planned expenditures. Salaries obviously are a little bit more even through the year, but non-salary expenditure items may vary widely from being somewhat equal month to month to having spikes in them. You must at a minimum always be looking at 18 months. That's the current year plus the first half of the next year, or as you progress through the year, you're constantly updating this. 24 months is better in the kind of circumstances that we're in right now. And obviously, as you prepare cash flow, you have to look at all funds. This is critically important. On the monitoring side of the house, timeliness. So monthly reconciliations, and for some weeks in the year, those will need to be done weekly. You need to post your actual cash transactions and reconcile them. And as John's already alluded to, and Annette will certainly bring home here in a few minutes, you can't ignore your balance sheet accounts. Your accounts receivable and your accounts payables accounts both have direct impacts on cash. Again, each time that you're monitoring and updating as each month goes by in the fiscal year, you're adding that additional month. You're taking an updated look out there at that 18 to 24 month view as your actuals are posted. And you're updating, just as you do your budget on a regular basis, you're updating your cash flow for new information. For community colleges, the reference here to SACs on that previous slide obviously is your 311 report and your Q reports, your quarterly updates. And as you all know, on the community college side, cash flow is not a component of those reports. It is a good practice, but it's not required to be filed with the chancellor's office. But certainly from a best practice standpoint, you want to follow both the same advice I just gave on K-12, both for preparation and monitoring. You want to follow that on the community college side too. I want to pause for a moment and make sure that we understand clearly the definitions of these terms we're talking about. We throw around cash and cash position and cash flow. So cash is what really happens. It's the real world, right? In many respects, budget, as much as we depend on budget as a planning and accountability tool, budget's kind of the make-believe world, right? It's all about what's anticipated to happen. But cash is a direct result of what actually happens. Cash flow is just that difference on a periodic basis, typically monthly, between the available cash at the beginning of that period and the available cash at the end of that period. The actual inflow and outflow of funds is what makes up our cash flow. Cash position is the balance at the end of the period. It may not always be the end of the period. You may want to know what your cash position is on a given day, and you want to have updated information to be able to answer that question. And for almost everybody out there, some charters would not follow this, but for community colleges and for traditional K-12 districts, certainly your county treasurer as your own treasurer is key in helping you reconcile and balance cash. As John's alluded to, when we have negative cash positions, whether those are forecasted or actuals, those can be mitigated by borrowing, which is our real focus of this time today. John alluded to this. What is cash insolvency? He gave the example of private industry, but the same term applies to our K-14 education community in California. The definition of an insolvent school district or community college focuses on cash, doesn't focus on budget. It's when you have payroll expenses that exceed your available cash and you've exhausted all of your borrowing, all of your options to borrow funds. It's a function, certainly a deficit spending, erosion of fund balance, sustained negative cash flow, such as deferrals. But you must keep in mind that as the cartoon illustrated, cash is in fact king. And as my predecessor, Joel Montero, has always said, cash shows no mercy. You either have it or you don't have it. And if you've not done your planning adequately, you may find yourself in a position of not having it. And cash insolvency for all of us is the end of the road. It's the end of the game. And that is usually the trigger point for an emergency appropriation and apportionment from the state, which also results in changes in governance where your superintendent, president, chancellor, and your board of trustees or governing board their authority to govern is removed, and somebody else comes in and makes those decisions for you. So clearly this is something that you want to avoid at all costs. Also, it's important to understand the distinction between budget and cash flow. We've thrown those terms around and alluded to this, but I just want to take a minute here for a little deeper dive. Budget's always this annual number, right? Fiscal year July 1 to June 30th. It is, again, a little bit of the make-believe world in it. It's what we anticipate to happen. Every day of the fiscal year that passes, we rely less on budget and more on our actuals, where accounting kicks in this real world. We anticipate revenue or sources of revenue. We anticipate expenses and uses of our funds, and certainly what our reserve balances are. How we acknowledge that revenue follows the California School Accounting Manual for K-12 and generally accepted accounting principles regarding accruals and the recognition of revenue. For K-12 districts, we have obviously budgets with cash flows are due to your county superintendent July 1st. There's a 45-day revision, which is approaching very quickly here. And then you do a minimum of 2 updates during the year through the interim report cycle. They are all fund specifically. And for our community college colleagues, you know that your initial budget to the chancellor's office isn't due to on the 311 forms until October, and then you do quarterly updates. So the timing is a tad different for the community colleges. When we distinguish budget from cash flow breaks down that annual budget into months, periods of time, whatever makes sense. In some cases, that would be weekly, depending on what your actual cash flow is on a given day, a given time of the year. You may refine your forecast down to weeks. It is, as I've alluded to, based on actual receipts and disbursements and your available funds in the county treasury. With respect to the forecasting of cash flows I alluded to on the previous slide, it's annual data with time factors such as apportionment schedules built in. Cash and budget are equalized through the receivables and payables. So again, while it's critically important to pay attention to your balance sheet accounts, because that's where receivables and payables show up. Receivables and payables don't represent revenue and expenditures and reserves. They represent assets and liabilities on that balance sheet account, and they play an integral role, as Annette will walk you through in your cash forecast. Requires monthly updates, as we've alluded to. Often cash flow, not budget updates, but cash flow is the first sign of fiscal distress in a district. And you also have to remember that cash flow is a little different than budgets. While budgets are fund specific, cash flow, while it's tracked by fund, can be commingled, and as we're going to discuss here in a second, can be exchanged between funds on a temporary basis. So I'm going to introduce you to a sample cash flow. The same format's going to be used throughout the rest of this morning's webinar, and Annette will pick it up and take you through some details. But I really want to point out that the example that's before you here are months across the top. We don't start till January, and then we go through December, almost like a calendar year, but you'll actually be doing this cash flow as a fiscal year. And the dark line there in the center represents the split between 2 fiscal years. And Annette will walk you through those details more in a second. On the left side, obviously, your sources and uses of items. And so I want to point out here that there's no borrowing. There's no due to, due froms. There's no trans issues. Those are the blue lines 2/3 of the way through. And you can see, and I want to draw your attention to May and June, where we have deficit cash positions, 3.27 million and 9.77 million. And so those become the problem that we're trying to solve for in our discussion today. So I want to first turn to the topic of internal cash borrowing. Alternative liquidity is a fancy term that we use that says what's the available cash resources and other funds. And some of these funds, the majority of the funds are going to be internal to the district, held in the county treasury, but there may be occasion where some of these other accessible funds are outside the county treasury being held by a fiscal agent. But whatever the case for you, I think the application here still applies. Borrowing cash from one fund to satisfy the temporary shortfalls in another fund is very commonplace. I emphasize, though, some key words. One is borrowing and one is temporary. Cash transactions are that. These are not budget transactions. Borrowed funds by law shall not be available for appropriation or considered income to the fund that's borrowing them. It's not about covering your budget deficits, it's about cash shortfalls. If you're going to cover budget deficits with funds outside the general fund, as an example, that's a different transaction, and that's not our focus today. Certainly for K-12, there are limits around the amount you can borrow and the timelines that are applicable. Some of those limits and timelines apply to community college districts when you look at outside the internal borrowing, but they don't apply to the community college districts on internal borrowing. You have quite a bit more flexibility there than K-12. These two ed code sections are specific to K-12. It is not comparable ed code for our community college partners. 42603 is the longstanding authority to temporarily borrow cash, transfer funds from one fund to another fund for the payment of obligations. It requires repayment in the same fiscal year or the subsequent fiscal year when certain conditions are met. And under longstanding provisions, you cannot borrow more than 75% of the fund balance in the sending fund. So if the general fund is going to borrow $1 million from the special reserve fund for a K-12 district, you have to ensure that that $1 million is 75% or less of the special reserve fund's balance. We have a special provision, which was part of the Budget Act's flexibility for K-12, 42603.1. It's only applicable to the current year and next year. It expands the authority to increase that borrowing from 75% to 85%. However, to do so, that requires a resolution of approval by your governing board subsequent to a public hearing. So there's some extra steps in the process. You may choose, a K-12 district may choose to follow 42603, it's still applicable, or you may choose, if you need those additional 10% dollars, to follow 42603.1. The only distinction between the two is that the board needs to approve it by resolution subsequent to a public hearing. Otherwise, the repayment terms and timelines remain the same. Again, for community college districts, there are no limits except those that you've imposed locally through governing board policy. Your best practice, very candidly, is to follow at the community college these same provisions in K-12. You want to get your governing board's approval. You should set some maximums, and you should set a very clear timeline for the repayment. Those are important best practices. Well, I want to provide a slight caveat on internal cash borrowing. While the Ed Code does not limit interfund borrowing to particular funds, we wanted to caution you, along with our partners at CDIAC, which are part of this seminar, that borrowing from bond proceeds is not always advisable, and under some circumstances may clearly be inappropriate. But this ultimately is a local decision that you need to make. You need to make it in consultation with your bond counsel, and have full disclosure, not only to your bond holders, but also to your community on how you're using those bond proceeds, even on a temporary basis. I understand that this topic is certainly subject to debate, but my emphasis here is this is a local decision, but you need to take and perform some extra due diligence with respect to borrowing bond proceeds. Again, want to turn to our sample cash flow, but this time it's with internal borrowing. And so that middle blue line there, you can see that we've now, in attempting to solve our problem, we just followed our practice here of doing some internal borrowing. We borrowed $500,000 from Adult Education Fund and $3 million from Special Reserves for Capital Projects Funds, and added $3.5 million in April as a way to partially offset our May and June deficit. You can see that it wiped out the May deficit that originally was there, although it's left us with very little cash, certainly below the margin most of us would recommend. But we still have a deficit for June, so we still have a problem to solve. And that's when we turn to this idea of external borrowing. I want to remind everybody that there are a number of choices for external borrowing. County superintendent of schools have authority to loan school districts and community colleges funds. They may also approve conditional advanced apportionments of state funds. The code sections that are listed there are for K-12. There are comparable code sections for community colleges, 85221 and 85222. The county treasurer, who is the treasurer for a school district and community colleges, in that neither of those entities have their own treasury functions. They are completely reliant on the county treasurer. The county treasurer also has authority to issue, under certain timelines and maximums, both in the Constitution and in the Ed Code, advanced apportionments to LEAs and community college districts. The authority there listed 42620 is for K-12. The comparable authority for community college districts is 85220. Finally, as John's alluded to, you may turn to the financial markets, and most specifically for short-term cash flow needs and working capital, you would use a TRAN, as we've defined, a tax and revenue anticipation note. And so with that, I'm going to turn it over to Annette, and she'll walk you through some of the details related to TRANs and TRAN sizings and issuance. Annette?
Had to unmute myself, my favorite phrase. Thanks, Mike and John, and thanks to the treasurer for providing this opportunity. Before I start talking about TRANs and cash flows, I want to provide a little bit of background about myself. My name is Annette Yee, and I work for Montague DeRosa & Associates. We are the municipal advisor for the CSFA pooled TRAN program for K-14 districts and county offices of education. We also advise CSFA on pooled TRANs for charter schools, otherwise known as the Advances on State Aid Payments, or ASAP program. I helped create the Los Angeles County Pooled Financing Program back in 1985 to assist districts with their financing needs, and I've worked on it ever since. By pooling districts together in a financing, we are able to reduce costs for each district. These were the first pooled financing programs created for school districts in the state. I've also served as a school board member at Carmel Unified for the past 26 years. Today, I would like to talk more about TRANs and why they might be particularly important to districts during this COVID-19 pandemic and the accompanying recession. Having completed at least one TRAN financing every year since '89, our advisory team is experienced with these tools and are ready to help you now as we work through these tough times. Okay, on to the presentation. In my remarks today, I will be talking about issues that relate to K-12 districts, community colleges, county offices of education, charter schools, and other LEAs, although the example comes from a K-12 district. Understanding and monitoring cash is critical, especially under current circumstances. Many districts in the state may run out of cash in their general funds this year because of the deferral of state aid revenues starting in February. If a district runs out of cash, they might require a state loan and the services of Mike Fine and FICMAT. We are here today to help your district avoid that terrible situation. As John and Mike discussed, there are a number of ways to help with your general fund cash flow. I'm going to focus on TRANs today. TRANs are issued to even out temporary cash deficits caused by uneven receipt of revenues, such as from property taxes, or this year, by deferred state aid. TRANs cannot solve structural budget deficits. A tax-exempt TRAN will have a lower borrowing cost than a taxable TRAN. Investors are willing to accept a lower interest rate because they won't pay taxes on that investment. We can help you with a taxable TRAN if you need one, but here I'll be focusing on tax-exempt TRANs, as they are much more common. There are rules associated with issuing on a tax-exempt basis. One such rule is that the cash flow deficit must be met within 6 months of issuance. Another is that repayment must happen within 13 months. Deferrals in February, June 2021 will cause districts to hit their low cash point sometime in June. Since the maximum projected cash deficit must be within 6 months of issuance, a TRAN to cover state deferrals can't fund until January 2021 or later. The targeted funding date for the CSFA K-14 districts TRAN pool is late February. I'm reading the wrong part. I got all thrown off. You know, Mike Fine was doing John Gray's slides. I should have had him do mine. With the state deferrals, it is likely that districts will be at their low cash low point at the end of June 2021. Since that low cash low point must be met within 6 months of the TRAN issuance, this means a TRAN to assist a district with a cash flow shortfall due to the state aid deferrals may not close until the beginning of January 2021. Because the deferrals are scheduled to begin in February 2021, we anticipate closing the CSFA K-14 districts TRAN pool by late February. This TRAN is known as a cross-fiscal year TRAN because it will be borrowed in 2020-21, but not be repaid until fiscal year 21-22. In case you need funds sooner than February 2021, we are also planning a November pool for those districts that are having cash flow issues prior to the deferrals. You may have already attended webinars about cash deferrals or even about cash flows and cash flow management. We will continue the discussion here about the monthly cash flow that you will be preparing to help you determine if your district needs to issue a TRAN and if so, how large it will need to be. Charter schools will not need to prepare cash flows to participate in the ASAP program, but you may want to listen in, as this skill is one that might be useful to learn. Here is a very high-level summarized TRAN cash flow for a school or community college district. This is the cash flow for the same district that Mike Fine showed you earlier to show you interfund borrowing. In your actual cash flow, you would have line items for major object code categories. We have simplified the cash flow to illustrate the big picture ideas. I am just giving you more of a cash flow 101 and continuing the cash flow story for this district. Cash flows usually cover fiscal years from July through June, as Mike mentioned, and they will tie out to your district's budget. For this presentation, we are showing you the calendar year cash flow from January through December, so you can see the effects of the cross fiscal year TRAN all on one page. As Mike mentioned earlier, the heavy vertical line distinguishes between June and July to delineate the end of this fiscal year and the beginning of the next. A TRAN cash flow is done only for the district's general fund. Let me walk you through this sample. As you can see from the top of each column, it shows monthly entries. The idea is to track cash over time for the district. Any numbers that are in parentheses are negative are reductions in cash. In any month with a negative ending cash balance, the district needs to find a cash source to supplement the general fund for that period. In this example, you can see on the bottom row that the district ends with a negative cash balance in only 1 month, June 2021. You may recall from Mike's presentation that the district initially projected being negative for both May and June, but interfund borrowing took care of the May deficit. I will be showing shaded or highlighted cells to draw your attention to the appropriate places on them. Here, the highlighted rows show the income statement. These rows display the cash projected to come into the district each month from revenues and cash out of the district when expenditures are made. We'll be coming back to these rows in a few moments. This highlighted section represents changes in the balance sheet of the district. Those changes must be included in a cash flow because they affect your district's cash. For instance, when funds are received, your cash will increase and your accounts receivable will decrease, and cash paid out as accounts payable are settled reduce cash. Accounts receivable are a part of current assets and accounts payable are incorporated under current liabilities. Even if an item is not attributable to the current fiscal year, it still can affect this year's cash. This is the most complicated part of a cash flow to understand. The key is to remember that anything that will increase or decrease the cash of the district should be included in the cash flow. That is why the balance sheet is an important component of the cash flow. Next, let's look at the cash balance lines. At the top of the chart, the beginning cash balance displays the cash at the beginning of the month. The $21 million shown in January 2021 is a carryover from the December 2020 ending cash balance. Toward the bottom of the chart, the net change in cash entries are the revenues less expenditures from the income statement, plus the balance sheet items for each month. The ending cash balance is the beginning cash balance plus the net change in cash and is carried forward as the next month's beginning cash. So the ending balance in January is the beginning balance in February, and February's ending cash is March's beginning cash, and so on. The very bottom line in the cash flow shows the ending cash balance for the district if they do not issue a TRAN. It is just the ending cash balance, which is the line just above, less any entries for the TRAN. Let's stay on this slide for a bit longer to have a brief discussion about how to do your cash flow projections. Even if you are a K-12 school district and complete cash flows as part of your interim reports or budget, you may not feel expert in doing this. If you are a community college district, a charter, or other LEA, you may never have prepared a monthly cash flow. The place to start is your district's past history. Go back at least 3 years to check your actual monthly cash flows. Become familiar with how monies come into and flow out of your district. The best way to predict how your cash will flow in the future is to start with what actually happened in the past. You will then add in any other changes that are appropriate. For instance, if you know that your district gave a raise, the figures in the salary and benefits expenditures lines should be updated. We don't show these lines on this summary cash flow example, but they will be part of a regular cash flow. Similarly, any changes from the past on the revenue side should be included. A big one for this year would certainly be the deferrals. Now let's go back up to the principal apportionment and the fiscal year 2020-21 principal apportionment deferrals lines so I can highlight these deferrals. Those are the two lines in the blue near the top of the chart. As you can see, we have shown the deferrals as negative offsets of the apportionment that was scheduled to be received in each month. Similarly, we show the deferred revenues received in the next fiscal year to the right of the black vertical line. These deferred revenues are expected to come in from July through November and will be used to repay the TRAN issue. Now we go back down to the bottom line. As you can see from the ending balances without a TRAN, the district starts off with a healthy cash balance, but as the months go on after the deferrals begin, their cash flow position erodes, bottoming out with a negative $6.27 million in cash at the end of June, even after they have done interfund borrowing, as Mike went over with you. This number is known as the maximum cash flow deficit, and we will be discussing it more later. In our example, this district would benefit from a TRAN, and it should size its TRAN to cover that $6.27 million negative cash balance. Because it is difficult to precisely predict cash flow, the tax rules allow a district to borrow more than their maximum projected deficit. Now turn your attention to the TRAN issuance row that is highlighted in blue. As you can see, this district has assumed a cross-fiscal year TRAN amount of $12 million with TRAN proceeds received in February 2021. You can also see the repayment of the TRAN starting in July 2021 and continuing through November. These are the negative cash numbers in that blue row to the right of the fiscal year vertical line. The $12 million cross-year TRAN received this fiscal year will be repaid in the next fiscal year, because that is when the district will receive its deferred payments. These negative numbers are called the TRAN set-aside payments. We have only shown principal repayments here, but the final payment in November will also include interest due. The TRAN itself will mature in December or January, so it has to be paid back by then. The negative $6.7 million deficit highlighted in yellow in the cash without TRAN line is offset by the $12 million TRAN, leaving the ending cash balance, including the TRAN, as a positive $5,730,000 at June 30, 2021. The $12 million TRAN covers the projected deficit with a cushion. We will now move on to the TRAN sizing worksheet to talk about this cushion and how a TRAN is sized. Take a look at the TRAN sizing worksheet. Now for this example, we have simplified some of the steps in calculating the TRAN size, such as whether the district is a small or large issuer and other nuances. We will go over these nuances with you when you are doing your actual TRAN cash flow. Despite these simplifications, this sheet gives you a general idea of how a cross-fiscal year TRAN is sized. One last thing. The term maximum size is used several different ways in this table. We have highlighted the differences in blue to help delineate them. The highlighted line at the top of this chart shows the maximum cash flow deficit from the cash flow worksheet, the negative 6.27 million. The next line shows the cushion we talked about before. It is called the working capital reserve, and it is generally equal to 5% of general fund expenditures from the prior year. This allowance is incorporated into the tax provisions because it is very difficult to predict cash flow with a high level of accuracy. Moving down the chart, the deficit and cushion are added together. In this example, that amount is 14.769 million. Your tax counsel will adjust this amount downward slightly by an amount that may vary by law firm, resulting in the adjusted maximum TRAN size as based on the tax rules. In this case, we decreased it by 10%. The bottom highlighted row displays that amount rounded to the nearest 5,000, which in this case is 13.29 million. There are three potential determinants of maximum TRAN size, and this is one of them. The other two potential determinants of the maximum TRAN size are the amount of deferrals that your district receives and the resolution passed by your governing board that authorizes a not to exceed amount. The amount authorized by the board has to be determined well in advance of the detailed sizing calculations, so the amount that is expected to be deferred can help inform the board resolution amount. The reason why a cross-fiscal year TRAN cannot exceed the deferred revenues is because it can be repaid only from the revenues that had been deferred. The repayment includes a small amount of interest, and that interest too must be included in the calculation. In this example, the total amount actually deferred from 2020-21 is 26.1 million, and with interest costs, that leads to a maximum TRAN size of a little over 25 million. We use this amount to recommend an authorized maximum size of 25 million, which is very close to the amount that could be borrowed because of the interest costs. The actual sizing of the TRAN cannot exceed the lowest of these three methods of determining maximum size. The three methods generate maximum sizes of 13.29 million, 25 million, and 25.09 million. Those are the lines that are now highlighted in blue. The smallest is 13.29 million, which is therefore the operative maximum size of the TRAN. Of course, in other situations, the deferred revenues with interest costs could have been the smallest number, or the smallest number could have come from the board resolution. So as I said, in this example, the maximum size of this TRAN is 13.29 million. However, as we showed on the cash flow sheet, the district chose a TRAN size of only $12 million. The district chose the lower amount because it was willing to do more interfund borrowing if needed. Borrowing from yourself is the least expensive way to cover a deficit in the general fund. Just remember, in most cases, you must repay such an interfund borrowing, and there are also specific rules that govern this type of borrowing. Let's turn to one last worksheet that is part of the TRAN cash flow that goes over interfund borrowing. This slide shows what is known as alternative liquidity in the world of TRANs. It displays some of the funds that a district can temporarily borrow from to supplement cash in the general fund. The specific funds on the chart are just examples. You may have other funds that could be used for borrowing. And I should also mention that the fund numbers on the chart are specific to K-12 districts. The numbering system may be a little different in other LEAs. And I should note that community colleges have different rules for interfund borrowing, as Mike Fine mentioned. If you represent a community college district, we'll work with you on these individually. Here, I've highlighted the balances in fiscal year 2020-21, and you can see that they are generally lower than in the other years. This is partially because the district has borrowed $3.5 million from these other funds during this year, as Mike showed you. Recall that you must not borrow from any funds that are prohibited from being used for cash flow purposes. Again, Mike went over some of these restrictions in detail earlier. You can see that healthy amounts remain in each of these funds for two reasons. First, it is prudent to keep enough cash in the district's other funds to allow the district to operate as needed and to be a further backstop for anything else that might happen to other revenues. And second, as the note on the bottom indicates, you are not allowed to borrow more than a certain proportion from any of those funds. As Mike noted, at least for K through 12 districts, the normal limit is 75%. But this year, the district can borrow up to 85% of the fund balance if it has taken the appropriate action to raise the limit. This leaves the district an additional cushion to borrow from if necessary. Again, it is cheapest for a district to borrow from its own funds whenever possible. Well, that's the end of my presentation. I hope I have helped demystify the TRAN cash flow a bit. I will leave you with one last thought. As important as it is to create your cash flow projections as accurately as you can, it is impossible to get them perfect. So you should continue to work with your cash flow as time goes on. You should monitor your actual cash flow, your actual revenues, expenditures, and balance sheet transactions. And as the fiscal year progresses, you can gauge the accuracy of your cash flow and adjust it as needed. This will allow you to meet certain requirements of the TRAN, like meeting your deficit target. But more importantly, it will allow you to manage your cash flow more wisely. Now, I would like to hand this off to Mike Kramer, who along with Katrina will talk with you about the plans for CSFA's two pooled TRAN programs. Mike has served as a municipal advisor to CSFA on various programs for over 15 years. Oops.
Okay, thank you, Annette. I'd like to take a few minutes to describe the essential features of the two TRAN pools CSFA is preparing to launch in the near term for the benefit of California local educational agencies, or LEAs. We're looking at page 48. One pool will serve the school districts, community college districts, and county offices of education throughout our state. The second pool will be open to California nonprofit charter schools, including charter management organizations, and also non-classroom based charter schools. TRANs from both series would be sold to investors through rated public offerings. There will be no cost to request financing from either pool. Each pool's issuance costs or fees will be low, with the State Treasurer's Office appointing all consultants and negotiating fees to be competitive with other TRAN pools. Let's first discuss the key features of the K-14 districts pool. CSFA will issue one or more series of pooled TRANs starting in February to bridge the cash shortfalls caused by the apportionment deferrals. Based on their particular cash situations, districts will have the option to wait and participate in additional series issued later in the spring. CSFA will also issue TRANs to provide short-term financing in November for seasonal cash shortfalls that often precede the receipt of property taxes in December. This is this November of 2020. Whether the TRANs are issued in November, February, or April, the maturity date is expected to be by December 2020 or January 2021. We expect the district TRANs to be issued tax exempt. The interest rate will be based on market conditions, and the high-grade credit ratings we expect to be assigned each district through a streamlined credit review process. Let's turn to the charter schools TRAN pool. This pool is also referred to as the ASAP program, with ASAP an acronym for Advances on State Aid Payments. Unlike the K-14 districts pool, where the tax-exempt TRAN will be sized using projections of monthly cash flows, the ASAP program expects to take a similar approach by sizing each charter school's TRAN using its apportionment deferrals and rating agency requirements. We will not be preparing monthly cash flows for the charter pools at this point. For charter schools to issue a tax-exempt TRAN, there would be significant expense for tax counsel to confirm the school's tax-exempt eligibility. Given the smaller sizes of charter school TRANs and historically low taxable interest rates, we expect a taxable TRAN to be more cost-effective than a tax-exempt TRAN. And thanks to a credit enhancement grant from the U.S. Department of Education used to fund a loss reserve for the TRAN investors, we expect the charter school TRANs to be assigned high-grade credit ratings. High credit ratings translate to low interest rates. CSFA plans to issue charter school TRANs starting in February. The TRANs are expected to mature in January 2021. Next slide, please. So here on this slide 49 are the pool TRANs and the steps to borrow. This page outlines the 7 main steps to issue TRANs through CSFA after the initial submission of an application. We anticipate this process will take approximately 4 months to complete. Step 1, districts will prepare monthly cash flows to determine their cash deficit used to size their TRAN. Like Annette described earlier, charter schools TRANs will be sized according to their apportionment deferrals and rating agency requirements. The financing team will provide assistance throughout this process and will coordinate the rating agency's review of credit materials. In steps 2 and 3, the bond counsel and disclosure counsel firms appointed by the state treasurer's office will draft resolutions, other financing documents, and the preliminary official statement, or POS. The POS will include information about each district or charter school participating in the pooled TRANs. Disclosure counsel staff will work with each LEA to assemble their section of the POS. In step 4, the authorizing resolutions and substantially complete versions of the financing documents and POS are provided to each participating LEA for their board actions. The CSFA board will be provided these same items for board actions authorizing the TRAN issuance. Moving down the page to step 5, the TRAN of each participating district will be assigned a credit rating, and districts with the same ratings and credit features will be grouped into one series. When the POS is deemed complete by CSFA, the state treasurer's office, and the financing team, the POS will be posted for review by investors. For participating charter schools, this process will be similar, with the main difference being that the TRAN of each charter school will not be assigned an individual credit rating. The charter school TRANs will be grouped into one or more series that is assigned a credit rating based on a credit assessment of each participant and the size of the reserve fund. In step 6, after the POS has been available for review by investors for about 1 week, the underwriter will run an order period to set the interest rate for each series of TRANs. The interest rate will be the lowest rate that fully places each series with investors. CSFA's financial advisor and the state treasurer's office will oversee the pricing process for the TRANs to ensure that the interest rates are fair and on market. Lastly, in step 7, within 1 week of TRANs pricing, the final official statement will be posted to the market. The TRAN proceeds will be provided to each LEA approximately 2 to 3 weeks following the TRAN pricing. Next, I will hand off to Katrina Johansson, CSFA's Executive Director, who will conclude our program and we will begin our Q&A session.
Thank you, Mike, for the TRAN pool overview. I just wanted to reiterate and emphasize some of the key features of the proposed CSFA pools. The pools will provide LEAs with TRANs that are secure, streamlined, and low cost. Our state-level intercept increases investor security while streamlining the payment process for LEAs. Our proposed financing team has been selected by CSFA and the State Treasurer's Office based on extensive K-14 TRAN experience and low fees. We anticipate having a CPA firm on hand to assist districts and county offices of education with the preparation of monthly cash flows. And our standardized financing documents will provide specific direction for board approval at the local level. The participation of many TRAN borrowers creates significant economies of scale, bringing costs down even further. These costs will be scaled to the TRAN borrowing size for greater equity among borrowers. And an online application portal developed by the State Treasurer's Office and IT division will ensure that the application process is streamlined while providing applicants with the assurance that their application has been received. We expect the application for both TRAN pools to be available during the month of August. Given the program's investor security features, CSFA anticipates high credit ratings and therefore low interest costs, as Mike mentioned. And lastly, we expect the larger pool size of the TRANs will attract more investors to reduce the overall borrowing cost. So the time is now 12:28. Mike, we have about 2 minutes left on our program, but we did want to open it up for questions. So Mike, have we received questions in the question box?
Yes, we have many questions.
Okay.
I will toss a few out there to the panelists, and those we cannot address, we will follow up in writing after the webinar is complete in the next couple of days. Okay, thank you. This question is addressed to John or Mike Fine. I think this is one of the first questions we got today. Can we expect that there will be an August revision to the governor's June 30th budget based on July 2020 tax receipts? This is related to any guidance on ADA funding expectations you can offer.
This is Mike. I don't expect any revisions except technical cleanup relative to existing policy.
This is John Gray, and I agree with that. Originally, we had heard right after the May revision that an August revision was likely. That has since changed, and so we just expect technical issues, but we're not expecting an August revision.
Okay, thank you both. Another question. We are getting conflicting information regarding if EPA funding is included in the deferrals. Can you please clarify? Secondly, we are also assuming that AB 602 payments are also included in the deferrals. Again, please clarify.
Okay, I believe if you look back to our chart, in fact, special ed funding is included in the deferrals, but the EPA is not. There's a lot of adjustments happening to the EPA, but based on our read of the budget and the budget documents, it's not included in the deferral.
And I would simply ask that the complications around EPA for 1920 were that our economy took an unexpected dive off of a cliff, at the beginning of the fourth quarter. EPA funds had been fully apportioned at that point based on the tax receipts we actually had. And so while EPA didn't have a June apportionment, that's because there weren't EPA funds to apportion. It wasn't that they were deferred for most districts. That will be worked through in 2021, obviously knowing where we're at. CDE will work through that. But let me say this again, if we had another mid-year dramatic change in state revenues mid-year, a decrease, it could have the same impact that we saw in 1920.
Okay, thank you both. Another question was, should we anticipate some sort of property tax deferrals? And if so, should we incorporate it in our cash flows?
No.
No.
Okay, an easy one, no. Okay, I think this question is for Mike Fine. In your example of the cash flow projection, you are assuming state deferrals for 2020-21 only. FCMET is recommending cash flow projections for 18 to 24 months. Should we assume same state deferral of apportionments for 21-22 as well?
Yes.
Our advice at this point would be, at a minimum, we would expect them to be flat for the next year. There certainly is the potential to increase. We would expect that fiscal year 21-22 will be the hardest budget year, assuming the economy does begin to turn around or continues its turnaround. A more complete answer of that's coming after the July 15th tax receipts are fully analyzed. But I think at this point, everybody should expect that 21-22 will be a much more difficult year than 2021. And because of that, I would expect cash deferrals to be a component of 21-22 into 22-23 as well.
Okay, thanks, Mike. We had a couple questions about pertaining to charter schools. Are new charter schools opening in 20-21 school year eligible for any TRANs loan? At this point, we do not think so. we think we'll have to meet certain rating requirements, as I mentioned. And one of those is that the school will need to be in operation for at least one full year, so through 1920. So schools opening this year will probably not be eligible for the charter trans pool.
Mike, can I
Sure, please.
We are opening up our revolving loan fund program for new charters. We're opening a subsequent funding round in August, and it will be an over-the-counter funding round. So please contact me after the webinar, and we can provide information on that.
Okay, that's great news. Thanks, Katrina. So another question was, if a charter school is not a nonprofit because it is a dependent charter, would the TRAN be included with the authorizing district? My answer to that question is probably yes, but it really depends on your specific charter district relationship. So I would contact them directly to inquire about that. One more question that came in a few times was regarding the sizing of the TRAN. There is no requirement that either a district, community college, or a charter borrow the full amount of the deferrals. It will be up to your specific situation, how much you feel you need to borrow. And then for the K through 14 pool that has tax exempt requirements, it'll depend on those cash flows and the projected deficit. And that will dictate, and that kind of went through the maximum legal size of your TRAN. I think that's the bulk of the questions. We received a bunch, but many of them were similar, but we will respond to all of them through a posting. So Katrina, I'll turn it back over to you.
Thank you, Michael. And first off, I want to thank the 800 or so participants that took time out of their busy day to spend 90+ minutes with us today. We know that school leaders have a lot on their plates with school openings in a few weeks, so we appreciate your time today. Thank you, Jack O'Connell, for your remarks. And Treasurer Fiona Ma, thank you for your wisdom, insight, and enthusiasm, and always encouraging us to do better. And to our speakers, John Gray, Mike Fine, Annette Yee, and Mike Kramer, I think we can all agree that we're all a lot smarter after hearing your presentations. And last but not least, I want to thank our colleagues Robert, Karen, and Angela at CDIAC. Under Robert Berry's leadership, CDIAC has partnered with us to ensure this webinar ran seamlessly, despite the posting of the handout. We look forward to offering more webinars geared to California's education sector. And I just wanted to update folks that there should be a link in the chat section of how you can access the webinar as a PDF file. Mike Kramer, is that available to everyone?
Yes, it's in the chat section on the GoToWebinar dashboard. Yep.
Again, it is posted on the CSFA's webpage where you went to register for this presentation. There is a link to the webinar handout. So again, apologies for the technical glitch there, but we do appreciate everybody joining us today.